See, we will be addressing finance executives and definitely not IPCC or CPT or final students. So we need not go into the real basics. We are already having working experience, and besides that, they are all qualified either through CA or CW or ACS or some professional qualification they will be having. So therefore, it should be like that of a seminar type, workshop or seminar type, and we don't have to just go into greater details, but at the very important items on which we have got to bring a good coverage. So, firstly, their past, we don't have to make any inquiry. Past, we don't have to make any inquiry. What is the extent of knowledge and all that. So, normally in a CA class, we used to make an assumption that students are not knowing anything on the basics. So, we start from the basic level. So, here it is a workshop sort of thing that we will be doing. So, we don't have to just go into the past. And even if there were to be some doubts on that, definitely we'll go back on to that specifics and we can get back to our, yeah. So, as of now, I wanted to try on IAS 16. IAS 16. Property, plant and equipment is the title of this particular accounting standard. So, before I could dwell on this, let me also tell you I told about the audience, I will tell you about what is the focus area. We will be concentrating on IFRS as well as Ind AS. So, the present one, we can call it as Indian GAAP. So, to differentiate with other items, we will say firstly Indian GAAP, the present one, IFRS followed by, or internationally people are following IFRS, and we will be following Ind AS for level 1 companies from 1/4/2016. This is the accounting period date from which we will have it done. It is not for all types or all levels of enterprises on the same day. So, firstly they start with level 1 and then gradually to level 2 and level 3. So, but the going is going to be a very challenging one. So, now let us just start our discussion. So, our Indian GAAP has got a lot of shortcomings, and IFRS is real dynamic, and Ind AS is a modified version of IFRS. What is Ind AS? Is modified version of IFRS. Modified version of IFRS suiting our Indian business scenario. So, where we have legislation in a particular way, which may be different from that of the international practices. So, therefore, we can't adopt 100% IFRS. We need to adapt IFRS to Indian scenarios, and then we have got to take it up. Now, see, people like Money sir, who takes this Indian GAAP to students. So, at CA, IPCC level as well as on final level. So, he is equipped to take it up. So, his knowledge on Indian GAAP is very reasonably good. And for the other two participants, a little, what should I say, they need to equip to that level. But one good thing is that straight away we can learn IFRS and Ind AS without even having a grip on Ind AS. So, something what Mani sir has got to do is something extra. He has got to unlearn and then learn IFRS and Ind AS, which may not be the case for the other two participants. But anyway, majority of the provisions are the same. So, therefore, we will concentrate only on the differences. So, No problem.
Level 1 you said 2016 is the condition.
Right.
Any specific industries to be taken up on
Yeah.
level 1?
So level 1 is nothing but this non-SME category. Level 2 and level 3 are SME.
Only 3 levels. Level 1 is
non-SME. Level 2 is medium level and level 3 is small.
the implementation dates for these are not
known, but I am not knowing it right now. Exact dates, maybe 1/4/2018 and the other one is 1/4/2020, something like that. I am not very sure, but the dates are announced. Announced. And they have kept banking and insurance company away from this application of IFRS for the time being, especially the banking. Banking and insurance, where they will continue to follow Indian GAAP until to a stage where they will notify that it is mandatory for all. So now, how do we gallop this speed and cover up what is required for the seminar? So there is a beautiful source that we have. The source is our Indian GAAP is available in our CA final study material latest. All the text is available in Indian GAAP. The related problems are also worked out in our institute study material. So once we have the hard copy of or soft copy of this study material for CA final FR, we will be in a position to cover up our Indian GAAP. Then let me also tell you the source. How do we know something about IFRS? The gap between the distance between Indian GAAP and IFRS is also filled by our FR study material, where there is an exclusive topic where they discuss something about Indian GAAP, IFRS, US GAAP. So where they have tabulated almost all accounting standards. So therefore, our institute study material is the best source for progressing to the next level. We don't have to consult Pricewaterhouse thing or Deloitte or something like that. Our institute study material is more than sufficient. Now, the gap between IFRS and Ind AS, for which institute itself is providing another source. So the best part in this learning what is different from IFRS to Ind AS, we have, I have forgotten to bring, we have this text of Ind AS. This was published by our institute way back by 2011. So, where they have just done a wonderful thing. I was just really happy the way in which our institute had just done. They have copied IFRS to Indian version and some of those paragraphs which are not applicable, they have deleted. So, the spots where they have deleted, that paragraph they have not removed. So, there they have kept, say, paragraph number 77, you will be finding paragraph number 77, nothing there. And within brackets they have put refer appendix. Appendix A or appendix B. Go to appendix A or appendix B, whatever they are stating. There they have told, these were deleted for the sake of our Indian scenario. In order to match with the sequence of IFRS in the AS, we have just kept the same paragraph numbers only. So, wherever slots are vacant, those slots are eliminated for the purpose of following our Indian scenario. So, therefore, you have separate appendix for each accounting standard where they are telling us why they have removed. So, from our Indian GAAP to IFRS, you can travel with the help of study material, and from there to institute text of Ind AS, if you refer to, this appendix is giving you only the difference between IFRS and Ind AS. So, therefore, it is something like A is elder to B. by 3 years, B is elder to C by 2 years would mean A is elder to C by 5 years. That sort of easy link we have it. We don't have to refer to any textbook. So everything is available within our limits only. But this we will not tell to others. So it is only our internal resources for which I am telling you. You don't have to just refer to very big book authored by this PwC people and all that. So on seeing that itself, we will just get asleep. Whoever is sir, this big, thanks to Mani sir only. On seeing this, sir, this is good book, sir, we will buy. But there are very good points that they have just referred, but not required to this level. It is something like Ramaya's sort of book. So this is what in brief I am telling about the resources that are available within our own institute website where we can download and use them to the maximum. So firstly I told about audience and the resource that we are going to study. So now from where I have just taken up, I am going to try property, plant and equipment. This is nothing but two accounting standards they are addressing. One is IAS6 depreciation, the other one is IAS10 fixed assets. So 6 plus 10 is equal to 16. So it is not like this combination we find it in any place. So 6 plus 10 is equal to 16. So you can easily remember that fixed asset. IAS accommodates both IAS6 and IAS10. So one can easily remember IAS16 as embodiment of the two existing accounting standards. Now I am going to take up the difference between our existing IAS with IFRS. So I would like you people to just go through the appendix to find out the difference between IFRS and Ind AS. So you may not be finding much difference. You can consider at this point of time IFRS and Ind AS as one and the same. In majority of the cases, I will not say that in all cases it is like that, but in majority of the cases we have it like that only. So how we just take it up is we acquire, we charge depreciation, and before it is being sold, it may be kept as available for sale. This is a new concept that we have, and then we will be just discussing about as how it will be disposed and how it will be reported before disposition. So these are the ways through which normally a fixed asset will be dealt with. Shall I proceed? So this is IAS10 and IAS6 and IFRS is IAS16. So certain item of assets are excluded in the present day scenario, that being the real estate developers asset whatever they are buying, they don't accommodate under IAS10. Does not exclude. Here there is an exclusion. Here they are not saying these are all excluded. That means real estate developers asset is also part and parcel of property, plant and equipment. So exclusion is not there. So I will give you the slide. So there is not to be taken note. So component costing or component accounting. So this is not a new concept, but generally it is not followed in the present day scenario. You can't say it is not at all there in the present day. We do have it. Say what is this component costing and component accounting is that when we buy an asset, it is a composition of two separately identifiable items. So for example, car. Car has got a body and then engine. We don't identify them as two separate components. We consider that as one single unit. So there is always a chance that these two can be accommodated as two different assets if one can outlive the other one. So whereas this is happening in the case of aircraft. So where the body of the aircraft will last a little longer than the engine. Engine may be 3 times we may have to replace during the life of the body of the aircraft. So therefore, in those scenarios when they discuss, they give importance to this sort of component accounting, whereas in India we are not, we can't say it is not there, we don't just practice at all. So it is only recommendatory as of the present scenario, whereas in the case in IFRS, at the stage of every purchases, We just don't charge depreciation based on some percentage given by some statute or something like that. So here it is based on useful life. How many years, how many hours, depending upon as how they are measured and how cost can be recovered. So provision for dismantling. So as of now in IAS10, we don't find that the provision for dismantling is taken up for the purpose of capturing the cost. So let us just think about an oil rig that is being constructed in the high sea, or we can take up oil exploration even in the case of land or minerals that are excavated in the land. So as they explore for oil or for minerals in the land, we just find there is a cavity created or some ecological imbalance being set in. So once that license period is getting over, then the job of that company is to restore the position back to the same position as it was taken at the very initial stage. So 5 years of drilling would mean definitely a lot of damages they would have caused into the seabed, and all these rigged or superstructures constructed in the off sea cannot be left just like that. So they got to dismantle it. So what is to be capitalized when you ask as a question? IAS10 communicates something on expenditure incurred to bring the asset to the intended use and working condition. So we take into consideration even the borrowing cost also for capitalization. But beyond that, we don't see how the asset is disposed of at its useful life. So when a company is given a license to explore oil in the high sea, we are expected to consider the cost of removal of the plant at the end of 5th year as also part of the cost. When we recover in the form of charging depreciation, we are expected to charge depreciation not only on the construction cost but also for the dismantling cost, which is having no place in present day Indian GAAP. However, having said that, we should also acknowledge the fact that this matter was readily captured in IAS29, not through any of the paragraphs there, but some of the examples when they have just communicated as for what items we have got to create provisions, they have included this. So therefore, somewhere our Indian GAAP, present day GAAP is also dynamic, but thing is that the time at which it is to be conveyed, that is not the place they have conveyed. They have conveyed somewhere else. So therefore, it receives a lot of criticism that it is not dynamic. So there is also one more problem that we have. 5 years later, if it were to cost some 50 crores of rupees, it may not be appropriate to consider to the present day books at 50 crores. Your IFRS is communicating more about capturing that at the present value of 50 crores. So the present value factor which we normally use in corporate finance or financial management subject, which we think that it is not a matter at all in accounting, which is a very important matter once this IFRS is coming up. So lot of challenge will be there for auditors and for accountants and those who are helping to prepare the financial statement, that how a particular figure is arrived at. So that means I have to estimate the expenditure and estimate my cost of capital, and also take up the challenge of finding out what is the time frame within which I got to do it. Say sometimes dismantling may run for 1 or 2 years. Dismantling is not like putting a bomb and then just dismantling it. It will take enormous amount of time. So as how a ship is built, the dismantling of a ship is also going to take that much of time. So therefore, it becomes a little tight for us to estimate what could be the expenditure. Their estimation is required, and what is the time frame in which dismantling will be taken up, what is the cost of capital that we have got to adopt. So all these are going to be challenges. So therefore, this provision for dismantling for which our Indian GAAP has got no answer, or I would say answer is somewhere else, but not to the fullest extent as expected. So therefore, you may consider that they are not given at all, and not dealt in IAS10 but referred in IAS29, but no discounting is referred there. Whereas in IFRS, provision is to be made, discounting is mandatory. Here is a place where we have got to be very, very careful. When I am capturing at the very initial stage itself the cost of dismantling at present value today, what will be the fate of the asset during the course of the 5 years period? Should I compound it? So we need to understand that once an asset is capitalized, we cannot capitalize just like that. The future value of or I would just put it this way, present value we have captured, slowly we have got to increase the liability only, and by the time when dismantling is to be switched on, it should match with what was initially estimated as the future cost of dismantling. I will put it like this way. If 50 crores were to be a sum that we have predicted as a cost at the end of the 5th year, so at the very initial stage, we would have estimated as 27 crores, let us assume. So this 27 crores where we may have 15% cost of capital, we would have added on 27 crores, 15% for the first year, another 15% on 27 plus first year 15%. We would have compounded it, and by the time we are going in for dismantling, it should reach 50 crores. So therefore, you find our asset is crystallized at the very initial stage once the construction is getting over. Thereafter, the liability that we have created, only the liability will be compounded during a period of 5 years. And when I am compounding my liability, I am increasing my liability. Where is that I will be debiting? I will debit only to profit and loss account. My profit and loss account will suffer depreciation not only on the construction cost, but also taking into consideration the present value of dismantling cost plus the discounting factor where I am unwinding the discount, where I would say in simple terms we will be compounding our liability. That burden will be debited to P&L account. So there will be a lot of burden that we may have to prove in profit and loss account to the audience as why we are taking it up. So from 27 crores to 50 crores, the journey of 23 crores will be done on a gradual basis with the help of the cost of capital that we have chosen. So this cost of capital exercise is something new to our Indian GAAP. So almost we are expected to be equipped to find out what is the cost of capital. How we have got to compound it. Compounding formula is not a big issue. It is only a formula. We have got to take up the appropriate cost of capital. So therefore, usage of this cost of capital, usage of this PV factor, what is considered to be an SFM subject now has come to FR. So through the year, this 27 crores will gradually improve and become 50 crores, and your asset will be crystallized at the very initial stage, taking into consideration the cost of construction plus the present value of the dismantling cost. And thereafter, we have to charge a depreciation on the capitalized value through the period of 5 years, whatever may be the method that we follow. So this is what I would consider the striking difference between the present day Indian GAAP as well as the IFRS. Do you have any doubt?
The estimate for the dismantling cost as accountants will be restricted on the technical aspect. We will have to depend on the experts.
Naturally, the challenges are many. Then replacement. Say, as far as the replacement is concerned, when a new asset is bought and when old asset is to be removed, what is the present day treatment when you ask? Here they say that the new asset bought can be expensed, and let us protect the old one only. That will continue to be charged as depreciation, even though physically that asset may not be there at all. Only the new one would be continuing. This is the present day scenario. What is IFRS telling? I would just put it like this way. They have machine A. Machine A is replaced by machine B. Machine A will go off physically. No, replacement means it is completely going off. So I am substituting machine B in the place of machine A. Machine A's value only we have it in the books. Machine B, whatever cost that I have incurred to buy that item, I cannot capitalize. I will charge it to profit and loss account only. Machine B will be physically be available, but the treatment is that you will be debiting to profit and loss account the cost of the machinery, because it is not enhancing any capacity. It is only in the form of replacement. This is what it is presently we are following. That means I will have B, but I will continue with A's book value. This is our Indian gap. What IFRS is telling, once B is physically available, why should you have A in your books of accounts? Your existing asset which is continuing and which is getting replaced, that should be expense and not B. That is appropriate accounting. Capitalize existing asset is derecognized. So these are all basics only. See, the way in which business is conducted will remain the same before and after. Thing is that how we account, that is an area where we have to look at. Then spares. How we will consider this spare? The spare, whether it will be capitalized or it will be charged to expenditure related to fixed asset alone, it will be taken for capitalization. Supposing I normally use this as an example. This is not a pen. This is like a mouse only. So when we buy this item, many items when we buy, one or two additional items that we will be buying. So whether the cost attributable to the additional spare should be capitalized with this item or should that be considered as an inventory. So if I buy mouse like this, many in numbers, imagine I am just giving you an example only, which is very easily understandable. So when it can be used for many items, then it becomes inventory spares. When it is to be used for specific item, then it should be capitalized. This is what our existing US GAAP is telling. What in IFRS they are telling, if used for a period more than 1 year, any spare is an item under PPE only. There is no question of generally used, specifically used. Any item of asset that you buy, where it can be used for more than 1 year, it is to be taken up under PPE only. It is to be capitalized. Shall I proceed? Major inspection and overhaul. So what is our present day status? It should be expensed. Whereas there, because basically I am just bringing out only the difference between the two. You can guess what could be that. Capitalized, existing asset is derecognized. It is something similar to that of replacement only. Frequency of revaluation. Here there is no periodicity that we have for revaluation. When we are feeling like we can replace. Ad hoc system only. This is silent. How frequent and all that they are just doing. So it depends on the changes in the fair value of the PPE to be revalued. It all depends on the valuation, that is the fair value of the asset. Review of estimate of residual value. So this residual value is estimated at the very initial stage itself. Here also we can do that. So when we normally do the review of residual value, when an asset is bought, in order to charge depreciation, especially on straight line method, cost minus residual value, that residual value is initially decided. So is there any chance that the residual value can be reviewed? If a question is asked, we say that it will be reviewed only when revaluation is taken up. Whereas in this case, every year we have got to revalue. Every year we have got to revalue. So that means the quantum of charging of depreciation, even under straight line method, will not be same from year to year. Year to year, straight line method only, but year to year it will change. Because of the residual value that I got to review every time. So here we are saying keep quiet. Here they are saying please jump. Review of useful life. Normally it is carried out, but there is no periodicity that they keep. Here, as how residual value is done, same as the way useful life is also carried out. That means it is something like we get consult the doctor only when there is a malady, only when there is a symptom. There they are telling every 6 months you go and have medical checkup. Likewise, PP is also communicated with that same sort of mentality only. So you review the useful life at the end of each year, review the residual value at the end of each year. So therefore, when there is any change, upward or downward, they are not really worried about that. So upward or downward in revision will be carried out. See, in fact, here we say upward or downward revaluation when we carry out, we say that it is changes in accounting estimate. Whereas in IFRS they are telling upward or downward change in the review or upon review of life. when there is a change that is happening and because of that depreciation amount is getting changed, they say that it is change in accounting policy. So there is a striking difference on between the two. Requirement of review of method of depreciation. So there is no such requirement at all. So there is under present day scenario. Once it is decided means it is decided. WDV when you are decided, WDV forever. So unless there is a change in the statute or in the accounting standard, you will not change. So here at least every year end we have got to review that. Change in the method of charging depreciation. There is method, change in the method of charging depreciation. Almost it is the same. Here, how it is conveyed is change in accounting policy. Where they are saying it is changes in accounting estimate. Just now I was just referring about that. Then application of change in method. In India, we say in the method when you change, it is to be done retrospectively. Whereas there they are saying whatever that had happened has happened. So they have a concept of what ought not to be done if done is perfectly valid. So therefore there is no looking back onto that. So if at all any change is there, you adjust only with the opening balance and don't debit to current year's profit and loss account. So prospectively only. So these are the striking changes. So if you know the existing system, then you can easily compare. If you don't know the existing system, you can automatically jump into IFRS. That is what I am telling. So for some people like money, so for him it is going to be unlearning and then learning. Others it is not like that. So that's all as far as the basic changes. Of course, I have edited with a few. There are some more, at least some 16 or so. I remember that I just identified. So very important ones I am reading. Now, I would like to take up now on to a question. So, say as far as the audience is concerned, they are having practical experience or practical exposure. So, too much theory also they will go for dosing only. So, Mani was showing his symptoms within few minutes. So, attending to your class is a very difficult task. That requires a special skill. But to make it very live throughout, we have to get into some case study sort of thing. So, I just marked some 3 important questions. I don't know how many will be in a position to complete it before 8 o'clock, but definitely the first one we should be in a position to carry out. So, question number 1 we have. Mani, could you read out?
Number one, goal to grab financial statement standards, international financial reporting standards. In the year ending 31st March 2014, the following transactions occurred. On 1st April 2014, Boeing began the construction of a new production line. Costs relating to the line are as follows. It is cost of the basic materials, list price 12.5 million, plus a 20% trade discount, 10,000. Recoverable sales taxes incurred not included in the budget cost, 1,000. Employee cost for the construction cost of 3 months to 30 June 1,200. Other overheads directly related to construction go to 900. Payments to external obligations relating to construction factor. Expected dismantling and restoration cost, number 3, 22,000. Note 1. The production line took 2 months to make ready for use. It was brought into use on 31st May 2014. Note 2. The other overheads were incurred in the 2 months ending 31st May 2014. They included an abnormal cost of rupees 3 lakhs, cost of a major electrical fault. Note 3. The production line is expected to have useful economic life of 8 years. At the end of the time, Boeing is legally required to dismantle the plant in a specific manner and restore its location to an acceptable standard. The figure of 2 million included in the cost estimates is the amount that is expected to be incurred at the end of the useful life of the production plant. The appropriate rate to be used in discounting calculation is 5%. Present value of quantity payable in 8 years at a discount rate of 5% is approximately 0.68. Note 4. 4 years after being brought into use, Production line will require a major overhaul to ensure that it generates economic benefits for the second half of the fiscal year. Estimated cost of the overhaul at current prices is 3 million. Note by Govind, we compute its depreciation cost on a monthly basis. Notice no impairment of the plant after March 2000.
Okay. See, this is one full-fledged problem that you asked for some 13 marks or so. So, in one of the past examinations of ACCA related to this IFRS, they have asked. So, somewhere around 7-8 questions that they had, and I picked only 3 for today's discussion. So, how we need to make a presentation is that we need to keep our existing Indian GAAP, highlight the changes only. We don't have to just really go into the real depth. So, people are having some knowledge on the subject. So, the changes when we tell, they are equipped. So, now we are into the case study. So, in the case study, when we take it up, first thing we have got to hit is, this is on the first day when they started the construction, and they have given the items of cost that they have incurred. Some may be included, some may not be included at all. So, the discussion that we need to start is that the general accounting principle that we have is that all expenditure incurred until the asset is brought into the working condition, we will say that it is to be capitalized, which is correct as per Indian GAAP. But further to that, what is special in IFRS is that the cost of dismantling, which should also be captured, and the related disposition in the financial statement for us, how the liability is growing and how it is to be accounted for. These are the challenges that we have before us. So, first thing is that we have to tell our existing practice and how differently we have got to take it up in IFRS. So, here we say the cost of basic material list price is 12.5 and 20% trade discount. In our Indian US GAAP also, there is Indian GAAP, not US GAAP. Indian GAAP also, GAAP में सुनाले US GAAP दाम वर्ग. So, in Indian GAAP, we normally ignore or we will just deduct the discount, the related discount, and we would capture. There is no two opinion regarding whether this 10,000 thousands will be taken up or not. So, it will be taken up. We will not take it up at 12.5 million. Then, recoverable sales tax incurred not included in the purchase cost. Even though they got to pay to the supplier, it seems that this can be adjusted for some other payable of that. So, therefore, this item is not to be included in the cost which they themselves are directed in the problem itself. Recoverable or in capitalization process, we will ignore, or in the total we may have to deduct. So, one of these two we have got to follow. Then, employment cost of the construction staff for the 3 months to 30th of June 14. So, note 1. The production like took 2 months to make ready for use and was brought into use by 31st of May. So, any person for that matter will normally give a quotation which will normally be on the higher side. So, this is only an estimate, or possibly they could have even paid also. But how much is to be captured? If you ask a question based on note number 1, we have got to say that only 2 months cost we have to capture. The other one, we have got to go for expensing, because any payment that is being made after the asset is ready for its use, even though the item was paid for that construction, once it is ready for use, any expenditure that we incur cannot be taken for capitalization, that should be expense only. So, what we do is that on 1200, you will multiply it by 2 and divide it by 3. So, pro rata item that we have to take up is 1200 into 2 by 3, that works out to 800. Only 800 will be captured there. Then, other overheads directly related to the construction, note 2. The other overhead were incurred in 2 months by 31st of May. They included an abnormal cost of 3 lakhs caused by a major electrical fault. Any abnormality involved in the construction of an asset, even under Indian GAAP, we will not include at all. So, therefore, we will exclude it. It will not be taken for capitalization. I mean, only to the extent of 300. which amount is included under 900. That means we will take up 600 in our capitalization process. See, sometimes what will happen is that the liquidated damages that are being charged on us by the supplier, whether it is to be capitalized or not to be capitalized, for which there will be a lot of debate people will be just doing. So it is a fine or penalty that is being imposed by people, and therefore it is not a normal cost. Therefore, we should exclude. So whether it is a matter to be taken up or not, if you ask a question, there are some demurrages, liquidated damages, related items which might inflate the cost or which might alter the cost, for which foreign against views will always be there. Supposing an item of asset is imported and in a transit airport, when it is delayed because of a flight being missed, and where the flight will operate only thrice in a week or once in a week or something like that. So you just find somewhere in the transit go down, they may charge demurrage. So whether that is to be capitalized or not, if you ask a question, if it is a regular practice, people say that it should be included. People say that what is a sin that this asset that cost to accommodate this as an extra cost, there is no efficiency improvement that it is cost. It is purely an an administrative lapse, and for which fine is being paid and therefore not to be included. See, there are different versions that we have, but definitely we can tell in this particular case that abnormal cost of 300 should not be taken for capitalization. Therefore, the remaining 600 to be taken up. Then payments to external advisors related to the construction. So quite obvious that it is direct consulting fees to be included, to be capitalized at all. That is, we should capitalize totally, and there is no portion that we can exclude. Then expected dismantling cost, which they will be incurring after some point of time, for which note number 3 is provided. Let me just read out for you. This figure of 2 million included in the cost is expected to be incurred at the end of its useful life. That means 8 years. So 8 years later, if it is to cost 1 rupee, today's value it is 68 paisa. So what we are expected to do is 2000 should be multiplied by 68 paisa to arrive at the present value of such dismantling cost. So the items that are to be taken for capitalization are I would say that basic cost of 10,000, sales tax dash, employment cost 800, then other overheads 900 minus 300, 600, advisors payment of 500, then dismantling cost, it is 2000 multiplied by 0.68. How much is that? $1,360. So the total cost is 13,260. So indirectly they have referred that this asset will last for a period of 8 years. Where is that they have mentioned that it is for 8 years? They have mentioned it that at the end of 8 years dismantling and all that, when they have referred, we should only understand that it is 8 years. But some interesting moments that they have given in note number 4. If you look into this table, nowhere they have referred about note number 4. Now we are going to take it up for discussion. 4 years after being brought into use, the production line will require a major overhaul to ensure that it generates economic benefits for the second half of its useful life. So the estimated cost of overhaul at current prices is 3 million. So therefore, we should only split this into two. One, having 4 years of life, the other one having 8 years of life. How much of that 13,260 we should consider that it should be amortized over a period of 4 years would mean 3,000. This is component which will be taken for replacement every 4 years. That means the production line, the asset will last for totally 8 years. In that one component will have 2 times. I may have to firstly load once and replace it at the end of the 4th year one more time. So therefore it is something like a car is there which will last for 8 years. Engine will be there, and for the first 4 years one engine, and last 4 years another engine. So therefore 13,260 is the total cost would mean. So engine portion we have to take it out. We have to take it out from the entire lot, and where I have to charge the depreciation for 4 years period, and the remaining 10,260 I got to charge it in 8 years period. And there is no residual value that they have reported. So they charge depreciation on a monthly basis, and no impairment loss had taken place by 31st of March. I hope that you people would be knowing something about impairment loss. If it is not clear right now, I don't want to take it up right now for a discussion. So we will keep that pending, a little pending. So at this moment I would just say that we can charge depreciation. So what is per annum depreciation? So it is 3,000 divided by 4. However, we are not holding it for all the 12 months period during the current period, for per annum, just for the sake of computation. How much money? 750, and in this case 10,260. 1282.5. But for 10 months period, we are going to take it up. 750 divided by 12 into 10. 1282.5 divided by 12 into 10. 6. 1069 we can put it. So the sum of that comes to 1694. So now the worry in profit and loss account and the worry in the balance sheet are the two items that we got to address. So in profit and loss account, we got to charge depreciation 1694, and on the balance sheet, non-current asset, even though it is not horizontal format, just for the sake of understanding, I have noted that way. So it is the initial carrying amount. Initial carrying amount was 13,260 less depreciation 1694. 11,566. On the liability side, provision for dismantling. Initially recognized amount was 1360. This is dismantling at TB. 1360. So we will add for the present year's cost. So we may have to take up interest cost 1360 into 5% for 10 months period. It is just like any other interest computation. When we borrowed 1360 from somebody else, how we would have calculated interest. So it is a computation of interest only. Some 50 plus rupees. 57 we can put. So our 1417 is our provision for discount, and here interest cost we will debit 57. Say 10 months point is there. How means by 1st of April, for 1st of April only we are, they have just given you the information, no? So, April, May month only they are completing. This is 2 months, so the remaining is 10 months. This is a strict application of your IFRS. How it would have been had it not been a IFRS? Dismantling cost will not be there. There is no component costing. I will do that. Have you noted this one? This also I can send, no problem. So, in fact, I will send image file. So, in Indian GAAP, our cost of 13,260, from which we will be deducting the provision. You will ignore that. 1360. And you would have charged depreciation 11,900 divided by 8 into 10 by 12. So 11,900 by 8 is per annum depreciation. 10 by 12 is for the post construction period. So what we are ignoring is that one portion of the component, there is one portion of the asset will last only for 4 years, that we are ignoring, because anyway when replacement is taking place, the cost of replacement will expense it. Here we have to capitalize. This is Indian GAAP. So this way of bringing out interest cost and adding it to the opening balance is the one that they are calling it out as unwinding of discount. These are the jargons that are being used. It is computation of future value. So in simple terms, a colloquial vaddi kanakku. So I have taken a loan for 1360 at the rate of 5%. For 10 months it is 57 rupees. It is calculation of interest only. We have discounted, opposite of discounting, unwinding of discount is what they are telling. So the discounting is the reverse of future value computation. So they don't call it out as future value and all that. They use a term as unwinding of discount. So this is the answer for the first part of the question. Now we will take up on to question number 2. Are you clear about this? So question number 2. I think you can read, sir. Question number 2.
Zenbogen is an airline which treats its aircraft as complex non-current assets. The cost and other details of one of its aircraft are: exterior structure, purchase date is 1st April 2001, 1,20,000, for estimated life is 20 years, and interior cabin fittings replaced on 1st of April 2011 is 25,000. 5 years, loan 10,800 since 1st of April 2011. In the year ended 31st March 2015, the aircraft flew for 1,200 hours for 6 months to September 2014 and a further 1,000 hours in the subsequent 6 months till 31 3 On 1st of October 2014, the aircraft suffered a bird strike accident which damaged one of the engines beyond repair. This was replaced by a new engine with a 36,000 hours at cost of 10.8 million. The other engine has also damaged, but was repaired at a cost of 8 million. However, its remaining estimated life was shortened to 15,000 hours. The accident also caused a cosmetic damage to the exterior of the aircraft, which required repainting at the cost of 2 million. As the aircraft was out of service for some weeks due to the accident, Jetmohan took the opportunity to upgrade its cabin facilities at a cost of rupees 4.5 million. This did not increase the estimated remaining life of the cabin fittings, but the improved facilities enabled Jetmohan to substantially improve the air fares on its aircraft. Calculate the charges to the income statement in this aircraft for the year ended 31st March 2015 and its carrying amount in the balance sheet position as on the date. The post-accident changes are deemed effective from 1st of October 2015.
Right. So these are the real-time challenges that we find asked in the main examination. This will carry some 10 marks, 12 marks, 13 marks and all that. So not in every successive examination they ask. It is not asked that way because the area is vast. But when they ask, they will ask some very challenging questions. So here we find Jetmohan is an airline company. And having an aircraft is not like any other item of non-current asset. It is a special one, which they say it as a complex non-current asset. So non-current asset is the name that they have given. Had it been the present there is Indian gap, you would have said as fixed asset. See, now we find that there are three components that we have in this term airline. That is non-current asset. One is exterior structure, the outer shell, then the interiors, and we have the other one, engine. Not one, two on either side. And no residual value attributed to any of the component parts. We call it out as aircraft and we would have charged single depreciation taking all the three into consideration under the Indian gap. Whereas IFRS, where they are telling that they will have a different lives, would mean we should charge the depreciation based on useful life of the asset and not a blanket rate for all the items. So on 1st of April, it is not a new item that they are buying. It is not like the last problem where they have constructed on started constructing it by 1st of April. Here it is, the exterior structure was there from 1st of April 2001 and that will last for 20 years. So how many years passed by this point of time when you ask? I think so it should be 13 years. 2002, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 31st of March 2014. Till 14. Whereas we want it by 31st of March 2015. During the current period, some accident took place and all that. I am talking about the opening carrying amount as how it is to be computed, for which 13 years lapsed. Then, in this case, when they have replaced it by 1st of April 2011 for a period of 5 years would mean 12, 13, 14. 3 years gone, 2 more years left. Then, engine, same point of time they have just done. It is not in terms of years, but in terms of flying hours. So when both the engines are working only, it will fly. So therefore, when we have 36,000 flying hours would mean simultaneously they should operate. So 18,000 divided by 36,000 multiplied by 10,800 flown hours would mean accumulated depreciation so much. Is it not? 18,000 divided by 36,000 should give 1 hour will give you per hour rate into 10,800 hours they have flown. That means that much of depreciation they have charged. The remaining carrying amount can be worked out. So this is the first stage of our working. I mean, we will be in a position to bring out the opening balance of this asset which they have taken into three components. Now I will work out on that. See, as far as exterior is concerned, it is lakh and 20,000 with no residual value. 20 years would mean it is going to be 6,000 per annum. Rupees in thousands, life, depreciation per annum, number of years lapsed, 13, accumulated depreciation, 6,000 into 13, 78,000, and what is the carrying amount by 1st of April, 14. So, lakh and 20 minus 78, 42,000. Correct. Interior cabin, 25,000, 5 years, 5,000, 3 years, so 15,000, 10,000 left. Correct. Then engine, 18,000. This is two engines, each engine 9 million. So therefore it is 18. So life is 36k. So it is 500 per hour. 10,800 gone. So 5,400 here. Correct. So it is 12,600. 1,20,000 minus 78,000. 25,000 minus 15,000. 18,000 minus 5,400. This is the way through which you got. Okay. So during the period, say our period is 1/4/14 to 31/3/15. This area is split into two. Before accident, after accident. Before accident period, when the bird strike, they could just spot 6 months. So this is 1/4 to 39, 1/10 to 31/3. So therefore, all the three components you will take up exterior, interior, engine as half the amounts. Per annum 6,000. So therefore 3,000. Here it is 5,000. So 2,500. In this case, number of hours. So 500 into how many hours flown? 1,200. So 500 into 1,200, 600. This is in rupees and thousands. Correct. Okay. So carrying amount at the time of accident. So when it is 42,000, 42,000 minus 3,000 comes to 39,000. Interior 10,000 plus, minus 7,500. Engine 12,000 balance. So something had happened. Which and all items are undergoing a change, that we will check up. So they said aircraft suffered a bird strike. Accident which damaged one of the engines beyond repair. That means that should be condemned. And it will be replaced completely by a new one which will cost 10.8 million. So therefore this engine I split into two. Damaged or I will say completely damaged. Completely damaged. It should be 6,000. Then this should be partly damaged. 6,000. What has happened for partly damaged? That is the very important item. The other engine also damaged, but was repaired at 3 million. However, the estimated life was shortened to 15,000 hours. So I need to add repair cost, because without repair I cannot perform it. So therefore it should be capitalized and not to be charged to revenue. How much is that? 3 million. Million is always followed by 3 thousands. There is 3 zeros when everything is expressed in thousands. So 9,000 and life, remaining life. Here it is not total life. Estimated life was shortened to 15,000. That is, remaining estimated life is shortened to 15,000. Had it been the original one, so in 36,000, I have already flown 10,800. Now 1,200 would mean 12,000 only I have just flown. Correct. 36,000 minus 12,000 comes to 24,000 remaining. So 24 had become now as 15,000. So therefore, I will take up 15,000 here. Yeah. This is for partly damaged. So what is the charge for depreciation per annum? Depreciation per, not per annum, per hour. So 9,000 divided by 15,000. 0.6, huh? 600 per hour. Is that right? This is for, and completely damaged, I have to write it off. This will be written off. New item which is costing 10 lakhs. 10,800. Life 36,000 hours. Depreciation per hour 300 per hour. So number of hours 1,000. So therefore, depreciation in this case it is 300,000 and in this case 600,000. Therefore, I would say that and it is 900 here. Correct. So as far as the exterior is concerned, there are some changes that they have made. What is that? Repainting. So cosmetic changes, repainting, should that be capitalized or not? Why? See, further expenditure when it is to be capitalized, what IFRS is telling and what our Indian GAAP is telling, both are same. If further expenditure is incurred, when it is extending my capacity, when I am just getting extra benefit, which is greater than the initially estimated benefit, so only then such expenditure will be taken for capitalization. Here, the cabin what they have replaced, for which extra income is generated, for which there is an indication of the problem. Look into that. They have said as the aircraft was took opportunity to upgrade at 4.5, this did not increase the estimated remaining life of the cabin, but improved facility enabled to substantially increase the airfare. That means benefit is there for one item, benefit is not there for the other item. for the item where there is no extra benefit that we derive, it cannot be capitalized. It should be expense. So printing expenditure cannot be taken up at all. So therefore, here I would consider before and after my exterior will continue to be 3000 and I will not consider for capitalization purposes this 2 million that will be expensed off. Whereas the interior, for that interior what I have to do is 7500 plus 4.5 million, 4500 what I have, that being 12,000. So at this point of time, my remaining useful life is 3 years gone, half year gone, we have 1.5 years back, that is ahead. So what I would do is that this will be divided by 1.5 to be multiplied by half. Why it is to be divided by 1.5 is that, so we have 6 months in this period and we have 1 more year next to full financial year. So anything which is to be used for more than 1 year, it is a matter to be capitalized. Supposing if this expenditure were to be incurred now, where the asset can be used only for 1 year would mean, we will not capitalize, we will only expense it, because it is 1 year now. That is what they are telling. So more than 1 year it is capital asset. That is what they are bringing out. So how much is that? 4,000. So my carrying amount here plus 0, here my carrying amount is 4,500. Here what I have to do is that from here I got to reduce 6,000. I got to add 10,800. I got to add the repair cost of 3,000. Correct? Repair cost of 3,000. So a little, what should I say, clumsy way of presentation, but clarity will be there. So 39,000 minus 3,000, 36,000. So here it is 12,000 minus 4,000, 8,000. Here I got to accommodate 16,800, 19,800. Hmm? 12,000 minus 6,000 plus 10,800 plus 3,000, 19,800, 18,900. Yeah, that we have taken up here. So, so two problems only we are in a position to carry out today. So therefore, I would just suggest you to go through that once again. Thank you.